All right. Let's see here. It's Wednesday, December 30th. My voice is raspy, so please forgive me. What is it? Today's Wednesday, December 30th. Tomorrow, the market is closed at, I believe it's noon Central Time, 1 Eastern Time. It could be noon Eastern. I'm not sure off the top of my head. I'll figure that out and let you guys know before the market opens tomorrow. The only thing that I believe I have going into tomorrow, I've got some BABA calls that I swung, some Tesla calls that I swung, some MasterCard calls, and a bunch of Baidu that's all paid for, all covered runners. I kept rolling those all day long. I started at the 200s and at some point ended up at 220s. The original calls went up somewhere in the range of 10,000%. I had these since yesterday. So we bought yesterday anywhere between 30 to 35 cents, started loading up on them. So you're paying $30, $35 a contract. Every $30 contract right now, if you look at the roll where I rolled from the 200s to the 210s to the 220s, is now worth $1,100. 50 contracts cost $1,500 and it turned into $55,000. Obviously, I don't think anybody made that much, because if you did, you weren't playing by the rules. I played by the rules and I probably made 25. I'll take 1,500 into 25 grand any day of the week. So you play those right. That's how you compound your gains, the interest in your gains, and continue to roll closer to the money. The calls that are going to move the fastest are always going to be as they get closer to the money. They start holding premiums better and they start moving faster. So if we got in something at 30 cents, those same calls, and hopefully I don't lose you guys here. I'm going to try to look at this phone while I'm talking to you guys. So something that cost me 30 cents, I'm going to give you an example right now. Baidu. We were in the 200s for tomorrow originally. Okay, those 200s for tomorrow, 1988. So those 200s, had you kept them, they would not be worth $1,100. The only way that you got into $1,100 was by continuing to roll up and roll out, because the interest starts compounding. They would probably be worth somewhere around 60 to 75% of that had you just held them, which is fine. That's phenomenal. That's great. But if you want to compound your interest, you've got to learn how to roll. Esme, if you don't mind, can you hit the little mute button on your phone, the little mic down there? Just press it. So today we had 7 calls that went over 100%. 5 of those calls were picks that were from today. 2 of them were from yesterday. 1 we had go over 500%. 1 we had go 800%. Another one we had touch 3,000%. And that's the one that we, with compounding interest with gains and interest with our rolls, we turned it into 10,000%. I don't know anybody. I've never seen anybody. I've never looked at any platform, any service that I've ever seen anybody do that before. So the stuff that we're doing, guys, is honestly amazing. I feel like I almost want to scale it back, because you guys are going to get so spoiled that the minute you don't make money, you're probably going to be crying and think that this thing's rigged. The percentage that I just hit on that Baidu call that turned into 10,000%, I think, I could be wrong, I think once before I had a gainer that went over 10,000%, but I believe that was the highest gainer ever. So this service only started 2 months ago. We'll log it down today that the highest gain ever so far is 10,000%. My goal is to double that now. So now my next goal is to hit one that goes 20,000%. I really hope that you guys are taking advantage of learning from this service and learning about everything, about decay, about rolling, about options trading, calls, puts, how to work it up, down, how to buy the dip, how to get in and out of things quickly. So one thing that we definitely need to work on with a lot of people, they still have not done it, and I keep preaching it, is position sizing. If you can't tell me right now off the top of your head how much is in your account, how much your average normal size play will be, and then what's your half position, and if you can't figure out what your half position is, then we need to just stop right there and give up. So know your full size position, know your half size position, know how much do you go in with a lotto, to know the two instances of what a lotto is, and to know what a super lotto is. I will break those things down for you, even though they are all spelled out for you in the service. For me, this can be different for everybody, depending on your risk tolerance and what your risk level is, what your goals are, how fast you're trying to grow your account, how much you're willing to lose and risk in order to do that. For me personally, I've got a pretty diversified investing portfolio. With this service, what we're mostly teaching on the lucrative end is day trading more than anything. That's what most people are interested in. Day trading is probably maybe 25% of my portfolio. In all honesty, that is a giant amount to day trade. Most people would tell you that's insane because it's so risky and you can lose it all, and they'll give you a million reasons why. I'm willing to bet you that those people that give you all of these pessimistic reasons why are either A, somebody who's never day traded, or B, somebody who day traded and lost money immediately. And C, had no clue at any point what they were doing while they were trying to day trade. Day trading, if you talk to anybody that did it within the last 3 years, you might be talking to somebody that somewhat understands it now, as far as the platforms we can use and how rapidly we can create trades, how there's no commissions. It's a different ballgame now than it was 3 years ago. Anybody giving you any advice about day trading that is not day traded in the last year, please just take that advice, ball it up, stick it in that round suggestion bin underneath the desk. They are not going to give you any useful advice whatsoever. This year was so much different than the previous year, and so much different than the year before. And before that, it was just a bull run. Every year we've had a little dip. We had a scare in 18. We had the massive sell-off here in 20. We had a scare in 19. The market always bounces back as long as we don't go to World War III. The market's always going to bounce back. The only way you're going to lose money is because you don't know how to pick them and you're investing in companies that are not set up for success and set up to withhold something like Corona. If you're invested in a company right now that's a small cap company or a micro cap, and they don't really have any money on the books and they got a lot of debt, well, they could be tanking right now. And that's a bad pick. You got to see these things coming. So position sizing for me, 25% of my portfolio is for day trading. A very large position for me is for crypto, period, Bitcoin, Ethereum, plain and simple. I'll say it till I'm blue in the face. Every single chance that you have spare change laying around, you should buy Bitcoin. Do not stop buying Bitcoin. Do not look at what the price of Bitcoin even is unless it's just because you feel like it. Don't bother looking at the volatility. Don't try to time it. Don't try to buy at the lows and sell at the highs. Just buy it and hodl it. Hodl means hold on for dear life. For those of you that don't know, it's a crypto trading term. Buy Bitcoin, buy Ethereum, hodl it. Continue to buy it. Keep buying it for the next 20 years. Once everything's mined in 2040 and it's the rarest commodity on earth, it's going to be $1 million a coin. So keep buying it until then. And even then, you're still going to get a better return, I'm guessing, in 2040 off of your money just sitting in Bitcoin, even though it's going to stabilize at around 1 million, than you will from the 0.25% of an interest rate that you're getting from a bank right now. And I don't think the interest rates are going to change anytime soon. It's going to be a long time, I believe, until interest rates change. And even when they do, the returns are ridiculously minimal. It takes very little effort to beat what the banks are going to give you, or to beat what the quote-unquote market, which I don't understand that either. The S&P 500 should not determine what the strength of our economy or the market is. It's the top market cap 500 companies. There's companies in that top 500 that I believe won't even be here in 10 years and be completely bankrupt. So don't let people fool you into telling you that the SPY, the S&P 500, SPY, SPX, that is a direct correlation of how the economy is doing or how the market is doing. The SPY can be way down, and something like pot or precision medicine, biotech, stuff like that, it could be flying, and it can continue to fly all year while other stuff just stays flat or levels off. Or I'm pretty sure all these airlines that have taken these massive hits, they're in the S&P 500. So it takes minimal effort to beat the market. It takes next to no effort besides pushing a button to put your money into Bitcoin to beat the banks. And in my opinion, it takes owning half of Bitcoin right now at the level that it's at to be in the top 1% of the wealth in the United States come year 2040. Yes, it's a long way off, but I am 100% in on it. So getting in and out of plays today, we had some monster winners on Baidu, on Tesla, a few others. I can't even remember everything off the top of my head. All of them, I progressively locked in gains along the way. And if they were continuing to roll, I would continue to buy at a higher strike. Another technique that I do for those of you that have enough in your account and can afford to, if you're continuing to roll up to continue to compound your gains, there is no reason why you should sell the contract that you're in before you buy the higher strike. The reason why you're rolling is because the stock is rolling and you want to make more money. So it makes no sense to sell first, buy second. You buy your roll that you want to roll up into at the higher strike first and foremost, then you go back in and you sell your original call, and it most likely 9 times out of 10 is going to be higher than what you would have sold it for initially. Also, you might even want to hold on to it because it might be in an uptrend, and maybe it's in a gap that's $7 and it's headed up and it's only $2 above the lower channel. That thing's still got a lot more room to run before it's going to hit resistance. So why would I sell that? I want to sell it into resistance. If it's up $2 over the lower channel and it broke the moving averages from 3 and 5 minutes, that means it's reversing it or it's continuing. But it should continue to go before it finds resistance. So why sell it early? Why lose money on my premium when I sell and pay more money when I buy, then buy at the lower premium and then lock in more gains with my original premium? That was a mouthful right there and a lot. Does anybody have questions on anything that I've gone over so far? I'm going to keep it short and simple today. It is pretty much a holiday. The market is pretty much closed quick tomorrow. I've got a couple more points to go over. But as of right now, anybody have any questions? I'm literally going to put this on hold for a full 2 minutes for anybody to chime in, and I've got half an hour to kill. crowd today. Last call. Nobody has any questions so far. All right. Oh, somebody started a video call here. Who did that? Can you guys hear me?
Yeah, I can hear you.
Did you get a pop up on your screen now too for a video call? Who's this? Ron? All right.
I was trying to figure out exactly how to unmute myself.
I don't think it matters. You guys are all on here. It's fine. So does anybody have? Go ahead, Steve. I'm sure you got a question. Is that why you're unmuting yourself? What's up, dude?
Yeah, I was trying to get in on it, but what exactly? Like you said earlier about it's more volatile. Can you hear me?
Yeah, I hear you, bro. I just dropped a soda and it blew up all over the place. Exciting stuff.
That sucks. That's why you have dogs, right?
Go ahead. You're asking a question about volatility.
So you were saying earlier about it moves more and more beneficial whenever you're almost at the money. Are you talking about while you're in the money?
So, okay, if you, let's say something's at 195, okay? Like let's say Baidu. Baidu's at 195. We buy, it's bouncing above 195, and we know the next level up is 200. So we want to buy the 200 calls because those are going to end up being the ones that are in the money if it gets above 200. So as the week gets further along, it's harder and harder to play calls that are out of the money because decay is so bad because they have so little time to work out that any little pullback or any consolidation just starts eating away at whatever your premium is. So you got to start looking at those type of things, and you got to start figuring these things out too, because if you don't understand how decay works, you'll give up a lot of money just sitting there with your fingers crossed. Like I could tell you, like on let's see, QS, what was it? QS, whatever that is. I had a put play on that. Thanks, bud. we got the mop man coming in. I had a put play on QS yesterday. I believe it was. I think it was a fast play yesterday. That thing bagged like 150% yesterday. I think I went in as usual with whatever. My minimum's always 4 contracts. I always buy in multiples of 4. That's something that I teach. There's a reason why. Anybody that wants to sign up, you'll get it. It makes sense. Long story short, I kept telling you guys PLG, which means progressively locking your gains. I got out of 3 of the 4 contracts at 75, 100, and 150%. That's where I got out of 3 of my 4. I'm still holding my last one. It's literally been one day. Today is the next day. It is now down 80%. I held that runner because it's paid for, it's covered. Plus, I made more than what that thing can even, quote unquote, lose me going to $0. So I don't care about it. And it could still work out tomorrow. It's an $85 put. It's literally like $15 out of the money right now, which the odds of it working out are slim to none. But if it does, those puts are going to go up 1,500% and they're free. So why do I want to sell them? I leave them there, see if they work out. I could have went way off subject there, Steve, but did I kind of answer your question, or do I need to get more specific?
I guess I'm just kind of curious on kind of what makes your determination on what part of the week, what time of the day would you really consider buying in the money versus out of the money, or even at the money?
So so in the beginning of the week, like say Monday. Monday's the easiest day to trade. At the beginning of the week, if I'm looking, I study charts to see what the moving averages are for 5-day, 10-day, 15-day, 30-day, the 52-week moving average. I see how often companies are breaking through their 52-week high to show that there's an in-demandness for their stock. It's continuing to go up. So there's a ton of things that I look at on the list of about 300 stocks that we follow and are on my watch list. Now on Monday, you can buy almost anything you want, and as long as the stock doesn't move more than, say, 3% in either direction, as long as you didn't buy ridiculously out of the money, your call's not going to move that much. You might lose 50, 60% if it goes down 3%. Now, if you were to buy way out of the money, and then it seems like at the end of the day, there's absolutely no possible way that it can get to the strike price that you bought, at that point, it might become practically worthless. And that's where you'll see things towards the end of the week, like start becoming worth cents, and then they start getting down something that you might have bought for $5. And then all of a sudden, it looks like there's no chance for it to get to that strike because the charts might show at some point, the charts might show that it's going to take 2 gap ups to get to where your strike is. The market maker knows this. The market maker knows what the odds and the chance of profitability is for him and for you. And he knows that your odds are slim to none. And he'll start knocking them down, trying to force you to sell. And that's where at the end of the week, something that you paid $5 for on Monday, it might be worth 10 cents on Friday. And at the end of the day, it might go from 10 cents to, say, $1. But it never got back to the $5 where you bought it on Monday. That's how decay works, and you have to understand it because you can save yourself on plays that you messed up on by understanding decay. A perfect example, I mistimed Tesla betting on the S&P 500 ad for a week and a half in a row. But I continued to roll out and minimize my losses and not just let things go to zero. I continued to roll down my calls that were far out of the money, closer to the money. And I positioned myself so that I was ready when it did happen. I knew it was going to happen. So I positioned myself to continue to do it so that I was ready when it did. Sure enough, it happened. I cashed in on it. We made hundreds and hundreds of percent. And it was all about timing and understanding decay. Had I sat in those same calls that were like 3 weeks out at $750 and it never got to $750, well, they would have been worthless. But if I buy them at the end of the week and they cost next to nothing and it gets one quick pop, you can lose 90%, I can make 1,000%. Does that make sense on understanding when and why you want to enter and exit?
Yeah, that pretty much summed it up. That makes a lot of sense. Good deal.
And that's why, Steve, if you have your position sizing correct, it's really hard to lose money. Because as you've seen now, I'm sure, you can see me calling out reversals all the time. Like, I call them out before they happen. I let you guys know, hey, it's about to test this support level. If it breaks and it prints a few times, then we're out. If it breaks and prints one time, we'll stay in. 2 times maybe. 3 times, probably not. 4, absolutely, we're gone. Our prints I'm looking at are, what's that?
So if you're down and it's not going in your favor, and it just prints once, what were you saying about the printing?
So me, again, this goes back to your risk level. My risk level is extremely high because I have a very good grasp on the market and I understand things like what I just taught you. So say that I position size the same with Tesla. I paid $5 for a call at the beginning of the week, which means it's $500. It's now down 90%, so it's only worth $50. And then at the end of the day, I see that reversal. I know it's going to 90% sure try to gap up. I can go in and buy those same calls that are down 90% for 50 cents. And they might get to $3 really quick. And if I went in with the same amount, I made 600%. So I made 5 times whatever I originally went in with. And that's a scalp. You save your ass like that so many times. And understanding these things is what'll make and break you. The other thing that you have to understand is that if you're in a call towards the end of the week that's super far out of the money, and there's no way that it's going to get there unless it's an act of God, you need to understand that thing's going to go to zero. You have to trade that. You cannot hold on to that. Holding on to that is going to end up in, no matter what you gained on it, it's all going out the window plus whatever you bought it for.
Well, what's your suggestion on expiration dates? Let's just say you're day trading and you have an expiration date 3 days away versus a week away. I mean, obviously, the desire for somebody else to buy it at a later date is better. But like, what are your risks in buying a call within a day or two? You know, I mean, is that more of a risk, I guess you could say?
Well, so the closer the expiration, the more the risk. The further out the expiration, the longer you have until it expires, the less the risk is. I'm going to make it a point at some point here at one of our meetings to go over looking at like the beta and the gamma and all these different things that you can look at right on Robinhood on the stock. And those are the type of things that will make you understand how risky each play is. If you want to look, what's that?
The Greeks.
Exactly. If you want to just watch a video on the Greeks, it'll start teaching you that. So you'll start understanding what your risk is before you go in. But unless you're like Matrix Rain Man, what we're doing for the most part, if it's not a speculative play, if it's something we're day trading, our goal is to get as in and out as fast as possible for as much money as possible, and then to leave free covered runners after we've already profited on top of it. So we've got money in our pocket, we've got no risk, and we've got runners with the sky being the limit. That is what you want to do. That is the goal every day. If you execute your plan to perfection, like I did today, then you hit 7 of those things. So understanding that the further out the further out expiration, it has more time. So these things have intrinsic value. Basically, the value is determined by demand, by the stock price, and by the time. There's a timer running out on it. As the timer runs out, the premiums decay. So if you got more time, there's less decay. So for instance, I always recommend and suggest to people that are new to day trading that on a Thursday or a Friday, rather than try to day trade the next day's expiration, or if it's Friday, the same day's expiration, if you can afford to, trade the next week's expiration. They're going to be much more expensive, but they're going to be nowhere near as volatile. And as long as it stays like range bound, you're not going to get killed at all whatsoever. It's only if it starts breaking levels that you might lose 30 to 50%. It would be on you if you let that thing go to zero. That would just be stupid. You're not sticking to your plan. Now, on the same token, say you bought a call $20 out the money 2 weeks out. And let's say you bought that same call $20 out the money and it expires in 2 days. If that stock gets to where it is $20 up and it's in the money now, meaning that when you look at the money line, that call's below that line. If it's in the money, now you're already in the break even. Now you can't possibly lose. You're way up. If you look at the percentage gain though, on the one that expires this week, you might have made, say, I don't know, 1,000%. If you look at your one that expires in 2 weeks, maybe you made 200%. So do you see how it works as far as how volatile it is, whether you're playing closer or further away expiration, and why you pay more premiums? You pay more premiums because they've got a lot longer leash to work out. Awesome. Does anybody else got some more questions for me? I've got a whole 14 minutes left for anybody with questions. One thing that I do want to address before any more questions. I see somebody was about to ask. Give me 1 second. I don't think I ever got around to it. Position sizing is up to you to figure out with your risk tolerance. I know I went over how my portfolio's positioned size-wise as far as crypto and day trading. I didn't go over how I allocate long-term options portfolio, ETF, dividend, high growth. I've got, I don't know, 15 different portfolios that make up the rest of the pie of what I invest. But you also need to understand your position sizing as far as how much do you go in with on each play. That's up to you to determine based on your risk. 10% of whatever your day trading capital is, that is beyond aggressive. I am very aggressive, and I go in with 5% of whatever my trading capital is at the start of the day for any new position that I take at the beginning of the week. Then if I'm going in with a half position, then it's 2.5%. If I say lotto, I'm going in with 1%. Obviously, you can't be exact with these numbers because every contract's a different price, but you could try to get close. Lottos should be tried to be avoided at the beginning of the week unless you had a killer week the previous week and you've got tons of profit left over. Lottos should try to be only with profits as the week moves on. But if you want to buy a lotto without profits, a lotto, I will never allocate more than 1% for a lotto. A super lotto, you absolutely should not buy with anything but profits, and you absolutely should not allocate more than 1% to it, more like 0.5%, and you absolutely should expect it to go to zero and understand that you're holding a lottery ticket that if it hits, it's going to pay for every bad lottery ticket chance you took for the whole year. Does that all make sense? Now, in layman's terms, for round, even, easy numbers, if I'm starting my account with 100 grand, my goal is going to be to double that account. Everybody's got different goals. If that was me, my goal would be to double that in 2 months, 3 months, absolute worst max. Your goal might be to do it in a year. Well, if your goal is to do it in a year, then your risk tolerance means that it's a lot less than mine. You can get there in that year easier than I can get there in 3 months because I'm going to be taking on much more risk. So you might allocate 2.5% or 3% for your full size position. And then obviously your half, cut that in half. It's either going to be 1.5 or 1.25. And your lotto is going to be 1/5 of 3%. Whatever that is, I don't know what that is. 1/5 of 3% is going to be like 0.6%. So you would spend 0.66% of your total trading capital on your lottos. So for a $100,000 account, it's $5,000 a play, $2,500 a medium conviction play, $1,000 a lotto, and $500 for a super lotto. If any of that doesn't make sense, let me know. I will try to explain that in better detail. Can't believe I busted this soda.
Can't believe you call him my boy.
You be the bat boy next time.
There you go.
Okay.
Well, if nobody else has any other questions, man, I feel like I can get another good question out there.
Go for it.
Moving averages. Let's just say, you're talking about your 3 minute, your 5 minute, your 15, your 30, and your estimated moving average, your EMA.
Mm-hmm.
How exactly
Well, that's a personal question. I have no problem with personal questions. Everybody has a different theory, though. Two people can look at the same chart and can determine two different things. Some people can determine that the price crossing through the 3-minute and 5-minute moving average is bullish, while others might see it as it's going to top out and reverse as soon as it hits resistance, and they might see it as bearish. So for the most part, if you study looking at different patterns and charts, for the most part, those stay true. Obviously, they're not always true. Otherwise, everybody would play the stock market and everybody would know how to do it and everybody would be filthy rich. But for the most part, they usually work out the way the setups tell you they're going to work out.
Okay.
So the estimated moving average, Steve, just so you know, I don't use that at all. All I use is actual moving averages on my screen right now from today. And I only use these as a reference, and I use these to help guide me to, more so than anything, make decisions on whether I'm going to stay in a play longer or not. You'll start learning how to identify patterns, like when I say something's coiled, that means it's ready to move, like it's ready to go big, one way or the other. When something's coiling, again, it's up to the person reading the chart and examining it and giving it their explanation of what it's saying. I have a buddy who might be on this call. I don't know. He's a really good friend. He's one of the guys helping me develop this app we're working on. He is an eternal bear. I make fun of him all the time. All he ever wants to do is play puts. Never wants to play calls. So anytime I play a put, I literally blow up his phone with it because I think he gets excited. So I make fun of him all the time because we kill it on calls. He's an eternal bear. I'm an eternal bull. But we can both make money. The same calls that I made 10,000% on today, well, I'm sure there was a dip at some point. I know there was dips because I bought every dip. And I could have probably made 100% on a put scalp easily. So bulls and bears can both make money, and bullish means that you think something's going to go up, you're going to make money. That's why I always say bulls can make money, bears can make money. I'm always bullish because whether I'm betting bull or bear, I'm bullish that I'm going to win. The only people that don't make money are pigs. Pigs overstay their welcome. Pigs don't progressively lock in gains. Pigs think that everything they touch is going to turn to gold and that every stock goes straight up and that it's a rocket ship to Mars. Those people, they lose money week in and week out, and rather than wiring money out, they're wiring money into their account, and eventually their piggy bank goes gone and they're out of the game. Those people usually don't make it a year. The statistics off the top of my head, you'll have to Google this, I could be wrong, but I believe it's something like 90% of people that attempt to day trade as their full-time job or as a career fail. They do not make it. They pack their shit up. They give up. They go back to building out a portfolio that gets you minimal gains and put their hands in their pocket and look at their account once a year and usually shit their pants if the market is dropping because they don't understand the market. Now the other 10%, which is me and you guys and everybody that's going to join and everybody that's getting developed, they can become the 1%. Because the money that you can make in this is limitless. If you can go and turn $1,500 into $55,000 in a matter of hours, you can literally become a millionaire overnight with the right play. And if you learn how to mitigate your risk, which is the number one thing that I try to teach you guys, is that if you scalp, if you progressively lock in gains, if you leave runners that are covered, the ceiling is limitless and you will hit a play that knocks it out of the park like I seem to do weekly with something that goes berserk for 500% or more. So the reason why that happens is because I play by the rules. If something's breaking support, I get the hell out. I cut my losses. I survive. I maintain my capital. If you just keep going in, all in on everything, you're going to hit a losing streak and you're going to get your ass kicked and you're going to be out of the game. That was how I started. I learned the hard way many, many times in the beginning. It took a year of watching my account look like a roller coaster ride, for the most part up, but massive dips, before I finally learned my system that worked for me, that gives you a steady, not slow, but very aggressive line that is like at a 45-degree angle, returning usually 50% a month. So if you do what we teach, you will hit those home runs. If you go seeking those home runs and those grand slams, you will cough up all your money and you will say that I don't know what I'm doing, that day trading is for fools, and that we're all stupid.
That summed up my question pretty much, Anthony.
I'm glad to hear that, mister.
Would you like an EFW one?
No, sir. You know, I still have some of that shit in my garage.
Yeah, that shit works good, dude.
I use it to clean my motorcycle. That's it. I won't touch my car with it.
I do my windows.
No fingerprints, right? Unless there's anything on your finger.
Como se dice en español,
Oh, isn't it good how much life has changed since those times, Steve?
Man, dude, I can't even explain to you.
Oh, no more
What a raincoat.
juice, buddy.
Juice.
Does anybody else have any more questions, or are we gonna call it a night and enjoy our New Year's, guys?
Should we trade tomorrow as beginners?
Not unless you're trading next week's expirations. Either that or understand that 25% tomorrow is a phenomenal gain for a beginner, because it can move up 25% within 1 second after you purchasing it. It can go up 300% within 30 seconds of you purchasing it, and it can have a pullback and be worth nothing within 1 minute of you purchasing it. So unless you know what you're doing, not a very good idea. Or unless you're playing really small and you're doing it to teach yourself discipline and just go in and out and lock in your little tiny games, and all those base hits, by the end of the day, they add up to a home run. If you take out 4 plays and you positioned right and you take out 4 plays for 25%, that's the same as me hitting 100%. That's better than 90% of people do every single day. Did that thing stop recording? Or did it stay recording? It did? Okay, cool.
It doesn't need to be plugged in, right? That's what it's like.
No, yeah. All right, gentlemen. Y'all have a beautiful, blessed weekend, week, holiday. Have a good day trading in the market tomorrow. I will be, I'll be on in the morning just to babysit my, what is it? I think I got some Baidu. I got it right here in front of me. I got Baidu, MasterCard, Tesla, Baba, Goldman Sachs, Lam Research, whatever the hell QS is. I think it's QuantumScape, NVIDIA, and more MasterCard. I am in on all of those right now on a swing. The majority of them expire next week. They were swings that I had from like a day ago, and I decided to take profits and roll out to the following week with profits. But I'll be babysitting the ones that expire tomorrow in the morning, and then I will be clearing out my portfolio tomorrow. So I will have to reposition come Monday morning. Monday morning, my plan is to jump in the market and make some ridiculous money by 11 o'clock. And then start repositioning my entire portfolio, because tomorrow, before the market closes, anything that I'm down on, I'm selling it, because that chalks it up as a loss for tax purposes, and helps me out for how much I'm going to owe for all the money I've made day trading this year. So just want to give you guys the heads up on that. Look for me to not be doing very much or be very active on the war room updates tomorrow.
Sounds good, dude. Make some money.
All right, man. You guys take it easy. Happy New Year, guys.